Hello everyone. Yeah, so today's first trading video will be on the fair value gap. So what's the fair value gap? What is BC? What is CB? What's the consequent encroachment? What's the inversion when dealing with fair value gap? Or even the difference between fair value gap, a gap, and even volume balance we'll be discussing in this video. So basically we'll be going into it properly so that you can understand properly what it entails. So do want to stay with me to the very end while you learn on this journey. And if you're interested in forex trading videos for free, do subscribe to this community for quality content and like our contents. I'll see you in the inner video. Now we are on the chart. The first question is, what is the fair value gap? Now, simply put, a fair value gap is a three candlestick pattern in which the first candle does not overlap with the third candle. This is the first, this is the second, and this is the third when dealing with the bearish. The first candle's wick, say this wick, it does not overlap with the third candle's wick, or the candles themselves don't even overlap. Now, coming to the bullish aspect, what's the fair value gap? The fair value gap comes in when the first candle does also not overlap with third candle. But what I'm talking about here, the first candle's high, this is the high of the first candle, does not overlap with the third candle's low. So here, the first candle's low does not overlap with the third candle's high. So basically, you can see where the low and high stated here can tell the difference. Now, taking a closer look at this, we can see fully well that they actually do not overlap. So if I can extend this out, which you can actually do, so let me hold on my shift here. So I'm going to also extend this out too. You can clearly see there is no overlap. All right, I'll do the same for the bullish aspects. Extend this line to show that they are weak, they don't overlap, or even part of candles do not overlap. I'm also going to extend this over here. We can also see there is no overlap over here. So basically, there's no overlap in the two candles, that's the first and third respectively. Yeah, so what this is telling us is the fact that the fair value gap holds here. So this region over here is what is referred as the gap and is referred to as the fair value gap. So let me show you the region over here too. Yeah, so this is the fair value gap. The creator was write it as the FVG. So in case you see me using the FVG here, you know I'm referring to the fair value gap easily. Alright, so you just understand once that, oh yeah, this is fair value gap. So moving on with the lesson. So with that fully explained, let's see what's not a fair value gap in this situation. Now, if this first candle has is wick extending downwards, alright, and then the body also extending downwards, which means a very bearish engulf candle happening there. Okay, and the wick of the third one also goes up with its candle moving upward too, which means it's forming this pattern over here. And when we check the wicks, we don't see an overlap. So if something like this occurs in markets, what we're going to check right now is if there is an overlap or if there is no overlap. So the new high is not going to be here again. The new high is going to be around here, right? And the new low, yeah, the new low is going to be here. Cool. So basically what we're going to check right now is if there's going to be an overlap in the market, and both of us are going to check it together. Yeah, so to know if there's going to be an overlap, we'll extend these lines like we did the first time. Okay, so extending this out, and we're also going to extend for the height too. This for us to understand fully well what the fair value gap is and what it entails. So upon doing this, we're going to see fully well that the first candle and the third candle, they overlapped. Now when we talk about overlap, it means, yeah, between here you can see both candles form in this range, while this under end where we've not yet made them overlap, you can see there's a gap with neither the first or the third candle in it. You understand what I'm talking about? So this is what we talk about when we're dealing with the fair value gap. So this said carefully, the same situation that we did on the bearish also apply on the bullish. So don't make the video very long, but really impactful. Let's go straight into the real-time charts to understand better. Let's do this. Currently on the USD 15 minutes time frame, okay, we're going to be checking out for fair value gap situations. Remember, there's always a gap. Okay, so this way we are spotting our first fair value gap. So basically, I'm going to highlight this region out and take it into the future to see what happened there and the reactions we had there. Okay, so this for this region, and then we're also going to be showing you, wow, this is even a beautiful example, seeing it well. Okay, Now, I'm also going to show you another fair value gap position that I can spot over here. All right, this is the wick of the first candle, that's the high, and this is the low of the third candle. There's also a fair value gap over here. So this is a valid fair value gap position that I'll be working with. So we currently have two fair value gap positions over here. We'll come back to talk about them. I'll deal with BC, CB, the inversion, which I can still clearly see here, and I'll explain how you can use them to trade and make good profits. Okay, so let's continue the learning process. Okay, so our next aspect when dealing with fair value gap is to discuss CB and BC. Remember, this region over here is the fair value gap. So what does CB mean? CB means sell side imbalance, buy side inefficiency, while BC means buy side imbalance, sell side inefficiency. So to break them properly, CB dealing with sell side imbalance and the buy side inefficiency means the sell side was offered over here. You can see it's sell side offered, bearish, but the buy side was not enough, which means the buy side was inefficient to balance it out. Okay, so basically this, we can also refer to this as a bearish fair value gap. You can see it's coming all the way down. So let me use a part to show you. It's coming all the way down. You can see it's bearish. All right, I think that explains that. Okay, so let's talk about the BC now. The BC is the buy side imbalance and the sell side inefficiency. So what do we mean by buy side imbalance here? You can see the buy side was offered over here. Definitely, you can see the green candle going up, right? And moving upwards. But the sell side to balance this up was not there, so which means sell side is inefficient. You can also call this a bullish fair value gap for ease of reference. You can just refer to it as a bullish fair value gap to help you understand better without stressing yourself. All right. So basically, this is the CB and this is the BC. So you can understand this concept properly. Let's go into the charts, okay, understand it better. Let's do this. Okay, so basically, using this fair value gap we've drawn in the past, we can also see fully well that this is actually representing a bearish fair value gap. And the bearish fair value gap here is the CB, which is the sell side imbalance and the buy side inefficiency. So you can clearly see it over here. Now, before extending this, you can see here this is where the fair value gap laid out. And if we extend it out, you can see it keeps on moving forward and it has some reactions in the fair value gap region, which we'll be talking about shortly. Here, we can also see this aspect, but this time around, we are seeing a buy side imbalance. You can see the bullish candles going all the way up. From here, you can see these bullish candles going all the way up. Buy side imbalance, but there's no sell side to actually cover it up. That is the sell side inefficiency. So the market will definitely come back to that region, which it did, to fill it up before moving into profits. We'll be discussing this strategy properly very soon, so don't stay tuned. All right, so if you're getting value, do what to like and don't forget to share with your mentees and others out there that have an issue with the fair value gap. Okay, so let's continue. Now, understanding the feature of fair value gap, we've got into this stage. So what's next is for us to understand the principle of the consequent encroachment. Now, if I'm going to pick up this trend line right now, I'm going to use to form a straight line. I'll this at the center here. Usually at the center, that's 50% retracement region or the 50% zone where the market can react. And this is where we refer to as the consequent encroachment. It can be either here or it can also be with the bullish fair value gap over here too. So basically, it works both ways. And the market usually retraces when it gets to this zone, this in the market, all right, in the fair value gap. So basically, the market reacts there. So now this is the price, this price moving upward now. Right, so you can understand for this is the bearish asset, and we said this is sell side imbalance and buy side inefficiency. So for the market to fill this aspect over here, this imbalance are created by these candles. Okay, for the buy side to be now efficient, it has to go back to this place to fill it up. So now what the market does is to go with price, not necessarily just one candle. Several candles can go there, but I'm using one candle for explanation. All right, it can either be with the wick of the candle going straight to the 50% aspect, which is the consequent encroachment. Okay, sometimes you see me writing CE, or it goes above it and then the market also goes above it and then finally closes beneath. Now, if the market closes beneath this 50% aspect, which is the CE, it means that the market is reacting to the consequent encroachment. And the market is reacting to this consequent encroachment. In case you don't know what I'm talking about, this is what I'm talking about. The market is reacting to this consequent encroachment. All right, it means that the market is tendency for the markets to move all the way down and lead us into potential profits if you understand how the structure operates. All right, so I'm still teaching the fair value gap because it's very broad. Also teaching reversals of it, that's the inversion, so you can get it. The same thing applies over here. Now I'm going to use arrows so we don't spend too much time. If price comes all the way to this segment, takes the market all the way down, but later on closes above it, there tends to be a movement or reversal that will lead us into good profits in the future, which you can actually milk as traders. Now from this chart, I'm going to be drawing our consequent encroachment, which is over here, okay, from this first fair value gap we spotted initially. Now you see what I was talking about. The market actually came up after having this bearish fair value gap. Okay, this is our CB over here, the sell side imbalance and the buy side inefficiency. The market pulled all the way up, not just with one candle, but with several candles over some hours and got back to the consequent encroachment over here. Now, upon getting here, it didn't just stop there. It formed a doji candle, yeah, showing signs of reversal. It had lower moves over here. You can see the volume actually reduced over here, and then it started reversing all the way to the downside, giving those that enter this trade with a good risk reward ratio a good number of profits. Now, I usually enter my trades whenever dealing with a value gap with a 1:2 risk reward ratio. Okay, yes, you can make 1:3, 1:4, but my street aspect I work with here is 1:2. So I know that I'm either risking my $10 for $20 gains, $100 for $200. It depends on what your capital is and how to work with it. My stop loss here is usually above the fair value gap region. Yeah, and then the last aspect over here, good. The last support here, and then my take profit is 1:2 over here. Let's see if it actually hit our 1:2 in the market. So let's see. And yeah, it actually hit our 1:2 profit. You can see it slightly hit our profit, 1:2 profit here. So if we're going for 1:3, this is what would have happened to us. This is what I've observed based on back testing. The higher the risk reward ratio, the lesser the accuracy of your signals. So basically, you'll be hitting more of break even though because you have entered some profit. So 1:2 would have hit your TP and have been out. If you're waiting for 1:3, you'd have gotten to 1:2 and still be waiting and you'd have gotten out. Well, to 1:2 would have helped you out easily. Okay, so this is why I work with 1:2. In case I want to increase my stop loss, to have a very huge stop loss to cover the previous reactions, it will also go well. So people put their stop loss seriously above the fair value gap region or even using this previous candle as their stop loss. This way, you'd have gotten a 1:3 easily, hopefully. Let's check. Yeah, they've gotten close to 1:3, or even 1:3 with this aspect, but still, I would have still worked my 1:2 to make my profits. All right, and just know you're safe in the markets. So that's this aspect with this example. Let me show you the second aspect here so we can move on to the version. So now here, this is the second example over here, and we can clearly see fully well that the market actually has the consequent encroachment over here. So this is the midpoint. So let me just take this up so we can get it big properly. So yeah, this is the midpoint. I'm going to be explaining what happened over here. Yeah, so we can see this chart very well. I've actually extended the other example out. Okay, so this is it now. Now, if you look at this, I'm creating this video in May, and this is the recent chart. So you can see how recent this example is working with even recent chart matters or the chart data. So basically, this is a fair value gap over here, and this consequent encroachment we've gotten from it based on 50% region of the fair value gap. Now, what the market did was to come back to it. Now, imagine you're not seeing this entire price data. I'm supposed to use the tool for going back in past to retest and everything, but yeah, let me explain better. So basically, the market is going up right now, and then the market came back to retrace into the 70%, 50% zone, pardon. But when it came back into the 50% zone, it went beneath it, all right, but closed above it, showing fully that it's a valid zone. Not only that, it made other bullish signals going to the upside. So upon doing this, if you're in this region, you want to take a trade, this is what you must have done to enter this trade. So let me delete these aspects here so you can see how you'd have entered your trade properly. Now we're going bullish this time around. Okay, so you'd have entered around there at the close of this other candle. Remember, the candle went up, so basically somewhere around here, and then went all the way up. They have entered around there. Their stop loss, some of us, like I mentioned, use stop loss using previous part chart data, or use stop loss using the bullish candle over here at the end of the fair value gap. If you use that, you have very, very huge stop loss. But if you just use your stop loss as fair value gap region, you have a tighter stop loss, and which will give you a chance to get more TPs with higher risk reward ratio. But if you use your fair value gap, the candle itself, you still have stop loss that is good, but you might not hit your profit target. But this gave us a 1:2 with using the fair value gap region itself. If you use the entire candle there as a stop loss, you want to be safer, you will not hit your 1:2 properly before the market reverses down. Basically, it depends on what you're using your stop loss and how you feel you'll be safe in the market. All right. But just working with the fair value gap region is okay for your stop loss. Or using previous market data, if you take this market data out, you can know fully whether your stop loss should be beneath this region, because this is where the market actually overlaps. The previous market data and recent data overlaps. You can have a stop loss here, you can still have a good 1:2 in profits. So I hope you understand this concept properly. Alright, so I believe we'll be able to learn properly about the fair value gap here. This is just part one. Part two video will be released very soon. So do want to stay subscribed to this community for more forex trading updates. And join our communities on WhatsApp and Telegram for more updates too. I'll see you in the next. Peace.